There's a quiet shift happening in crypto right now, one that's easy to miss if you're only paying attention to meme coins or the latest airdrop meta. While most of the space is chasing short-term hype, a more traditional asset is starting to gain traction: US Treasuries. But not the kind you buy from your bank. These ones are tokenized, fully on-chain, backed by a real government debt, and already pulling in billions of dollars. BlackRock's new product, BUIDL, saw nearly $500 million in deposits within days. Ondo Finance has crossed over $1 billion. Even Fidelity is moving in, signaling that this isn't just a niche experiment anymore. Some believe tokenized treasuries could become a foundational building block in DeFi, offering real-world yield without ever leaving the blockchain. My name is Danny Lowe, and today we're breaking down what tokenized treasuries actually are, why institutions are piling in, and what still stands in the way of broader adoption. And if that sounds interesting to you, make sure to hit that subscribe button and ring the notification bell so you never miss future crypto updates. Alright, let's get into it. Institutional interest in tokenized treasuries has moved well beyond speculation. BlackRock's BUIDL fund, which launched in March, attracted nearly $500 million in deposits within its first week. That kind of capital doesn't just show up unless there's real confidence in the infrastructure, regulatory clarity, and underlying yield. This isn't a crypto-native gamble. It's traditional finance stepping onto the blockchain in size. At the same time, Ondo Finance has quietly grown its own suite of tokenized treasury products to over $1 billion in value, including OUSG and USDY, both designed to track short-duration US government bonds. Combined, these two issuers now account for a significant share of the entire tokenized treasury market. As of this month, that market has crossed $5 billion in total value locked. And it's not just crypto-first platforms leading the charge. Fidelity, one of the world's largest asset managers, is preparing to launch a digital money market fund. If that fund ends up tokenized or even integrated with blockchain rails, it could mark a major turning point in how traditional assets are distributed and settled on-chain. Behind all the scenes, infrastructure is maturing to support this shift. Copper, a custody provider catering to institutional clients, now supports Ondo's tokens. Other firms are working on permissioned pools, cross-chain access, and integrations with regulated broker-dealers. So what does all this mean? It means tokenized treasuries aren't just some DeFi niche. They're shaping up to be the on-chain entry point for institutional capital. For funds that aren't ready to dive into native crypto assets like Ethereum or Solana, let's say, tokenized US debt offers a familiar product with better transparency, 24/7 liquidity, and lower settlement risk. And for builders, this shift opens up new opportunities to create interfaces, money markets, and even cross-chain protocols that serve these assets natively. While institutional momentum around tokenized treasuries is undeniable, access for everyday crypto users still lags behind. Most of these products, including BlackRock's BUIDL and even Ondo's flagship OUSG, are only available to accredited investors through gated off-chain onboarding. That means if you're not a fund or qualified buyer, there's really no easy way to hold these assets directly in your wallet. And even for those who are eligible, the process often involves fiat transfers, KYC bottlenecks, and platform-specific custody rules that make it feel a lot more like traditional finance than crypto. That said, there are signs of progress. Ondo's USDY token is specifically designed to be more accessible, aiming to offer yield exposure in a way that's compatible with public chains and simpler user flows. Meanwhile, newer players like Mountain Protocol have launched yield-bearing stablecoins such as USDM that package tokenized treasuries into a familiar permissionless wrapper. These tokens still come with some restrictions, like regional limitations or backend compliance filters, but they hint at what a more retail-friendly RWA layer could look like. In fact, some users are already holding yield-bearing treasury exposure without realizing it. Protocols like Athena route collateral into short-term US debt behind the scenes. We're starting to see a new class of DeFi tools emerge, where users are just deposit stables and the yield happens in the background. Imagine you're sitting on $10,000 in USDC, but not actively trading. Today, that capital just sits idle. But what if your wallet automatically routed it into tokenized treasuries, earned 5% in the background, and let you pull it out instantly if you ever needed to? That's the kind of abstraction that could take RWAs from niche to default. Outside the US, things are moving even faster. In Europe, platforms like Assetera are now offering institutions access to tokenized US treasuries. And while retail access isn't fully open yet, it's a sign that regulatory clarity is starting to widen the pipeline globally. If the infrastructure keeps improving and more compliant wrappers come online, tokenized treasures could eventually become as easy to use as USDC or DAI, not just as a yield-bearing product for funds, but a savings tool for anyone holding stablecoins. Stablecoins are everywhere in crypto. They're fast, liquid, and deeply integrated into almost every protocol. Whether it's USDC, USDT, or DAI, stablecoins have become the default way to hold dollars on chain. But while they're convenient, most stablecoins come with one key trade-off. They don't offer any yield. You're holding an asset that mimics a dollar, but it's not working for you. In fact, in many cases, it's working for someone else, usually the issuer, who's parking the reserves in short-term government bonds and pocketing the returns. That's not a small detail. In 2023 alone, Circle reportedly earned hundreds of millions of dollars from the interest generated by USDC's underlying assets. That money doesn't just get passed through to users, it stays with the issuer. And that gap is where tokenized treasuries start to look appealing. Instead of being the product, you're the beneficiary. These tokens are directly backed by short duration US debt and pass through the yield, often 4 to 5% to the holder. The trade-off, of course, is liquidity and accessibility. Tokenized treasuries often can't be instantly redeemed, can come with compliance restrictions, and aren't yet composable across the broader DeFi ecosystem. But it's not necessarily about one replacing the other. It's more like a separation of purpose. Stablecoins are your checking account. Quick, flexible, built for spending and transferring value. Tokenized treasuries, on the other hand, are your savings layer. Slower, yield-bearing, and built to store capital more efficiently. Over time, we may even see a convergence. Imagine a new class of stablecoins that bundle in treasury yield by default, or automated money markets that shift idle balances into tokenized treasuries behind the scenes. You wouldn't need to click a button or move funds to a new platform. It would just happen. Set it and forget it. We're not fully there yet, but the distinction between holding and growing capital on chain is starting to matter more than ever. Tokenized treasuries may be getting the spotlight right now, but they're only one piece of a much larger shift. The broader category of tokenized real-world assets, or RWAs, has already surpassed 20 billion in total value on chain, and according to some forecasts, that number could climb into the trillions by the end of the decade. And unlike synthetic yield farms or speculative governance tokens, these are assets people already trust. They just haven't been accessible through crypto rails until now. And if you're wondering why that matters, the more of this stuff that gets tokenized, the more your future portfolio might start to live on-chain too. RWAs aren't just for institutions. Once these pipes are laid, the same rails used to tokenize private equity or commercial real estate could also power user-facing products like yield-bearing stables, tokenized payroll, or even dividend streaming assets. The appeal is straightforward. Tokenizing traditional assets makes them more accessible, more transparent, and, in many cases, more efficient to manage. On-chain settlement removes middlemen. Global access unlocks new liquidity. And blockchain-native rails make it possible to do things like automate compliance, issue programmable dividends, or wrap financial instruments into composable DeFi products. For institutions, it's about efficiency, and for protocols, it's about interoperability. For users, it's about finally getting access to assets that were previously locked behind traditional financial walls. Some see tokenized treasuries as the gateway asset, the low-risk starting point that helps traditional allocators get comfortable with on-chain exposure. Once they're in, the path to exploring deeper yield, permissioned credit pools, or tokenized real estate becomes much easier. And while the Ethereum ecosystem is leading with protocols like Centrifuge and Maple focused on credit and lending, Solana is getting traction with more retail-accessible platforms like Ondo and Parcel, signaling that RWA adoption isn't going to be limited to just one chain. Behind the scenes, the infrastructure is catching up. Custody providers like Copper are adding support for tokenized treasuries. Regulated platforms are emerging to offer onboarding, reporting, and redemption services. And builders are starting to think about what a native RWA layer could look like, not just wrappers for off-chain products, but as a foundation for new financial applications altogether. Tokenized treasuries might be the first breakout use case, but the real story is much bigger. This isn't just about bridging traditional finance and crypto, it's about rebuilding parts of the financial system with better tools and fewer gatekeepers. And just when momentum was building, things got messy. For all the growth and optimism around tokenized treasuries, there are still major hurdles standing in the way of mainstream adoption. The most obvious one is access. Most of these products aren't available to global users or everyday wallet holders. they're gated behind compliance layers, available only to accredited investors or restricted by geography. That's starting to improve, but we're still far from permissionless plug-and-play experience like we have with stablecoins. Then there's composability. Today, tokenized treasuries mostly exist in their own isolated wrappers. You can't lend them out on Aave, stake them across chains, or use them as collateral in most DeFi protocols. And without deeper integrations, these assets function more like siloed products than native building blocks. And for a lot of users, that lack of flexibility is a deal breaker. I mean, even infrastructure is uneven. Secondary markets are shallow, on-chain liquidity is limited, and few platforms offer real-time price discovery. While some providers are pushing forward on custody and compliance, the experience still feels fragmented, especially compared to the seamless flows most of us are used to in DeFi. But the biggest challenge of them all might be trust. As the RWA label gains traction, more projects are starting to use it, and not all of them live up to the pitch. We've seen instances where tokens labeled as RWAs have experienced significant volatility due to factors like forced liquidations or large-scale sell-offs. These events can shake confidence and make it harder for serious builders to gain traction. So, while the opportunity is real, the road to adoption still depends on better infrastructure, smarter integrations, and clear standards, not just more headlines. Tokenized treasuries are quietly becoming one of the most promising bridges between traditional finance and the crypto world. They're backed by real-world assets, offer meaningful yield, and are already seeing strong demand from institutions. But despite all that momentum, the reality is this space is still early. Access is limited, integrations are shallow, and there's still confusion around what actually qualifies as a legitimate RWA product. The good news is that the foundations are being laid, infrastructure is improving, retail-facing products are starting to appear, and serious players are continuing to build. If this trend plays out the way many expect, tokenized treasuries won't stay a niche. They'll become a core layer in how value moves on-chain, not just for the funds and whales, but for everyday users looking for safer ways to earn yield. Let me know in the comments, would you actually hold tokenized treasuries in your wallet, or are we still too early for that to make sense? And if you haven't already, make sure to subscribe and turn on notifications so you don't miss the next deep dive. Thanks for watching, and I'll see you in the next one.